All right, so I want to take some time to show you how the Fed raising rates has no effect on the long-term rates, at least that you can ascertain and say, if they do this, it will lead to that. Let's go into the Federal Reserve Treasury.gov daily yield Treasury yield curve rate. So what the Fed was doing in 2004 to 2006, I think it's 2004 to 2005, is they raised 17 times, my friends, 17 times. And that's a significant move on the short-term side of things. But because they raised 17 times, you'd think the long-term rates would go up too, right? Because everyone thinks the Fed is raising, thus the long-term rates have to go up for your mortgages, your long-term bonds, and things of that nature. And we'll watch. So, all right. Again, this is through the Federal Reserve Treasury.gov. You can just type in daily interest rates, Treasury, daily Treasury rates, Treasury.gov, yield rates, yield rate curve, whatever you want to do, and you'll get this website. It's freaking awesome. I look at this all the time. So here we go to January 2004. So let's write this down. In January 2004, we got the 10-year, which we'll use the 10 as a proxy because they stopped issuing 30-year bonds back during that time. So we got a 10 at 4.38. Oops, let me just write that. Oops, hold on just a second. Got to erase that link. Oh boy, made a big old mess of this. So we got a 10, 4.38. This is in 2004, Jan. And we got the 1 month at 0.88. All right, so let's fast forward. We'll fast forward till September. September 2004, we got 1.56 on the 1 month. And the 10-year is this guy right here, 4.18. So they actually, interest rates actually doubled on the short term roughly, and they went down by 20 basis points on the 10-year. Essentially, I'd call that intermediate, not a long, but intermediate term. Let's go to the end of the year, and we see 1.89, 2004, December, 1.89, and then the 10-year is down to 4.24. Look at that. So the 10-year is just sitting there flat as can be, essentially, while the short-term rates have gone up basically 100 basis points, literally 100 basis points. Crazy. All right. So now, and if we look back at this to see what the rates on the bonds did, let's take a look. So let's just see what the bond rates did in 2004. Hold on just a second. Here's the Vanguard Long-Term Treasury Bond Fund, VUSTX. And in 2004, while the Fed was raising, what happened to this? It was actually up 7.212%. Isn't that interesting? Let's take a look at the Vanguard short term and see what that did. Hold on just a second. Here, the Vanguard short term Treasury was up 1.03. So essentially, the Fed was raising, had no impact whatsoever on the interest rates. The interest rates being raised had no effect whatsoever on the bond market in terms of investments, if that makes sense. So that's good. All right, so let's go back. We'll go to 2005 now. So go up here. We'll switch from 2004 to 2005. Crack how. All right. There we go. So we'll go to, let's see. We'll go to June. We'll go to September. Well, let's go to June. June 2005. We'll see. Here we are. 2.79 now. Oops. Okay. June 2005. June. 2.79. That's 300% higher than what it was in January 2004. So what's that? 18 months has gone from 0.88 to 2.79. What's the 10-year doing? It's down to 3.91. We'll go to, we'll just go to the end of the year here. We'll say what we do. September 2005 to September 2005, we are up to 3.38. The 10-year is at 4.02. And then we'll end the year 2005 in December. 2005 December, we are at 4%. We'll just say 4 for simplicity, and the longer term is 4.52. All right, so in those 2 years' times, the 10-year Treasury went from 4.38 all the way down to 3.91, all the way up to 4.52. The Fed, the short term went from 0.88 to 4%. 4%. So let's see what the bond markets did in 2005, shall we? So we go here in 2005. Short term was up 1.77. Let's see what the long term was up. In 2005, it was up 6.61. So the Fed was raising, and you still made 6.61% in your money in 2005 and 7.12 in your money on 2004, when the Fed was going from essentially less than 1 to freaking 4%. Crazy. So 2006, let's just go to 2006 and see. I think we have the inverted yield curve finally rears its ugly head right here. No, 4.01. Nope. Let's see, where's, so no inverted yield curve yet. Getting pretty close. So where's that 3.91? Yeah, so we don't have anything right here. Nope, no inverted yield curve in 2005. Nope. All right, so let's go to 2006 and see what we got. Now, of course, this is daily active. This is just day to day. So the intraday, there certainly could have been an inverted yield curve. So in 2006, we'll start with, we'll go back to June. We'll start the year 4.05. Let's see, I'm looking for an inverted yield curve here. 4.37, not quite there, not quite there. 4.38 to 4.58. 4.42, not quite there. Not quite there. 4.45, 4.45. 4.66 to 4.67. Getting pretty doggone close, but not quite there. 4.6. All right. 5.04 on the 10. 4.54 on the short term. Let's keep looking. We closed in on it. We'll go to June. In June, we had 5.11 in June and 4.75. 2006 June, we had 4.75 and 5.11 on the 10. And if we keep going down, we got 4.8, 5.02, still in the fives. Right here, 5.01 on the short term, 5.07 on the 10. Right here, so July 2006, right there, 4.99. And look, they start reissuing 30-year bonds again, by the way. 4.99 on the 10-year and 5.02 on the short term. But again, the markets did nothing but up from now until October 3rd, 2007. So if you were to say I'm getting out of the market then, you missed out on a significant gain. And then 5.2, look at that. So let's go to September. September, we had 5.07. Yeah, now it's a significant yield curve. 2006, September, 5.07 on the short and 4.73 on the long. Now, I mean, that's a pretty significant inverted yield curve. That's 27. That's 34 basis points or something like that. I mean, that's over 30. That's over 1/3% of an inverted yield curve. And we'll end the year here 4.75. So it stayed inverted for basically the whole end of the last 6 months of 2006. It stayed inverted. Now, there was a recession in real estate. I simply do not know if the recession happened in real estate, if it affected the GDP overall. I don't know. But I do know we had a recession for sure. But we can look. But at the end of the day, it doesn't matter because you made money in stocks. And let's see, I bet in 2006 you made money in bonds. Let's see. 2006, the long-term bond was up 1.74. Going to 2007, it was up 9.24. So the long-term treasury bonds, you still made money, even though we had a raising of the Feds and we had inverted yield curve. You still made 7.9%. And then even in 2008, of course, you made big bank in the long-term treasury. And if we go to short-term treasury, let's see, I'm sure it's made money too in 2006. Yeah, 3.77. So the short-term treasury, just look at that. I mean, you didn't make much, but you made money. So what's the point of this? The point is you can't extrapolate anything when it comes to your specific investments. Just because the Fed is raising does not inherently mean that the long-term rates are going to go down. Doesn't mean that you're going to lose money in the market and the bonds. Doesn't mean you're going to lose money in the stocks. I mean, the old rule of thumb is don't fight the Fed. Well, hell, the Fed was raising like freaking drunken sailors back in 2004, 5, and into 2006. Had nothing to do with the stock market. I mean, did the market go gangbusters? No, but it didn't go down. This whole thing where if the Fed does this or the interest rates do that, that would have any implication on your overall investment strategy. It just stop, because there is no X equals Y. There's no positive correlation that says if something happens here, this will be the result. It's not there. It's kind of like CO2. I mean, you cannot say CO2, if we have increased CO2 by turning the knob, this equals temperature increase. They can't do that. But people do. They're looking for a reason. Everyone needs a reason, but there is no reason here. So when it comes to your retirement planning portfolio, you got to look at inverted yield curve with a grain of salt. You got to look at recessions with a grain of salt. You got to look at the Fed raising with a grain of salt. It does not mean anything necessarily that's going to happen to your portfolio. I mean, it could, but there's no positive correlation to say if this happens, then that will. There is nothing there, as I just showed you. All right, we'll see you.